Hello everyone. Among the entire suite of mutual fund products available in India, there's one category of funds which have done extremely well over the past 3 years. Now, when the entire equity category of funds have given negative or flat returns in the past 3 years, this category of funds have delivered a return of more than 15% annualized returns for 3 years and more. Yes, more than 15% annualized returns. What are these funds? Friends, I'm talking about international equity funds and more specifically US focused equity funds. In this video, we'll understand what are international equity funds, how do they invest, how could they generate such kind of returns, and whether one should invest into such funds going forward or not. Hi, this is Kishan Jakhotia from Reliable Wealth, and this video is part of the learning initiative from our desk. To regularly receive more such videos from our desk, please subscribe to our channel and click the bell icon to receive notifications of all such videos which I would upload. Now, before going forward, let's first look at the kind of returns what these funds have generated, and let's try and compare these returns with our equity fund categories available in India. If you see some of these funds here, the ones which are popular like Franklin US Opportunities Fund, ICICI Prudential US Blue Chip Equity Fund and Motilal Oswal NASDAQ 100 Fund. These funds have given a return of more than 25% for the last 1 year and more than 15% annualized returns over the past 3 years. Compare this with the Indian indices returns over the past 1 and 3 years, where most of the indices are negative for the past 1 year and are flat or negative again for the past 3 years. Isn't this amazing? What are international equity funds? These are those funds which would basically be investing into companies listed on recognized stock exchanges or a mutual fund or an ETF outside the home country to generate returns. Investments could be specific to a country like US, a region which could be Asia without Japan, a continent which could be Europe, or it could be Asia, or a specific index which could be, let's say, an emerging market index. How do international equity funds invest? They primarily invest in two different ways. First, they identify a mutual fund or an ETF in a foreign country and invest into them. This is a much simpler way of investing because here the fund manager would not have to do his research of identifying companies in a foreign country and invest. It would directly invest into a foreign fund which is called as a master fund, and the Indian fund would be investing into master fund through a feeder fund route. An example for this would be DSP US Flexible Equity Fund, which is the Indian international fund, and it would be investing into BlackRock Global Fund's US Flexible Equity Fund, which would be called as a master fund. The second way of investing is to directly identify companies in a foreign market and invest into them. An example for this would be ICICI Prudential US Blue Chip Equity Fund, which would directly identify companies and invest into them. There could be different flavors of or different ways of investing also in international funds. One could be that there could be a fund which would probably invest 50% into India and maybe 50% into international markets. So there could be some flavors which could be available. Now, how do international funds generate returns? International funds generate returns in two different ways. One is market return and second is currency return. What are market returns? Market returns are pure return on investment, which means that if the price of the underlying holdings go up, then the fund would generate returns. What are currency returns? Currency returns are generated by the movement of currency. Let's look at this with an example. If you look at this example here, there is an investor who wants to invest 150 rupees in USA stocks. So at 75 rupees USD INR rate, he would get $2 to invest. Now let's say the company in which he wants to invest, the price of that company is $2 per share. So when he is investing $2, he would get 1 share in hand. Now let's say if the price of the share remains at $2 after 1 year and the company has not been performing well, so now he decides to sell this share after a year. Now when he sells this share, instead of receiving 150 rupees back into his account, he receives 165 rupees. Now how did this happen? He got a return of 10%. Now that return of 10% came not because the price of his underlying investment went up, but it went up because the value of rupee depreciated against dollar. So at the time of his selling, the price of USD INR was not 75 but it was 82.5, and hence he's received a return of 10%. Isn't this amazing? Now let's look at the performance of US markets in the past 3 and 5 years to understand how these funds have done well. If you see the slide in front of you, there are 4 different indices. 3 indices are from US, which are very widely followed globally, and the 4th one is NIFTY. Now if you see the returns of all these 4 indices over the past 1 year, you could see a huge variance in the returns. You could see NASDAQ giving about 27% type of return. This is possible because NASDAQ is primarily a technology heavy index, and in the COVID times such companies have done well. But if you extrapolate and see the last 5-year returns, the returns between, let's say, a Dow Jones, an S&P and the Nifty is not really much. It's just about 3%. So how could these funds give such kind of returns which we've seen earlier in the video? Now if you see this particular slide, I think you could see here that one of the main reasons why some of these international funds could give such high returns was because there was a lot of currency depreciation which have happened in the last 3 years. Now this is one of the major factors why some of these funds have given such high returns. So from both of these charts, you could understand that the returns which international funds generated came from a combination of market performance, technology stocks doing well, and currency depreciation. Given the fact that a good part of the returns have come from non-market factors, should one invest into such funds? Let's look at both the favorable and the unfavorable factors. First, diversification. Second, US is the world's largest economy and US dollar is the world's reserve currency. So by investing into US markets, one would basically be investing into some of the fastest growing companies and some of the largest companies in the world. Third, benefit from currency depreciation. Fourth, digitization. In the COVID era, some of the most advanced technology companies come from US markets, and hence investing into some of these companies via international funds could benefit investors in gaining returns. Investing into such markets when the markets are already high and some of the companies they are trading at all-time high valuations. Second, geopolitical risk and US being at the forefront of some of these issues. Third, deglobalization and some of these US companies facing the maximum brunt of deglobalization. Fourth, currency appreciation and the risk of not having any hedge on the currency. Fifth, missing the emerging market story. Sixth, Indian and US markets are positively correlated, so there is no real sense of diversification happening. Seventh, the last point and one of the most important ones, taxation. From a taxation point of view, such funds are treated as debt funds, which means to say that any investment held for less than 3 years is categorized as short term and more than 3 years is categorized as long term. So let's assume a scenario where US markets deliver a return of about 12% every year for the next 3 years, and at the end of 3 years, let's say the currency comes back to 70, which means that the currency falls by 10%. So in that scenario, taking into account the taxation of debt funds along with currency appreciation, an investor would end up making a return of about 7 to 8% post-tax, which is not something very substantial, because that kind of return can be earned even in some of these debt funds here in India. So after looking at all of these positive, negative, favorable and unfavorable points, my view would be that one should avoid investing into such funds at this point in time. But if one wishes to be aggressive, some part of the portfolio, which could be about 5% of the portfolio, can go into such funds. I hope I was able to address all the points which you wanted to know. If there's anything more which you would want to know, please mention about it in the comment section below. Or you could also reach out to me on my email ID or mobile number given in the description below. If you have liked this video, please support us by subscribing to our channel and also by sharing this video with your family and friends so that you could help them in gaining good insights on investing. Thank you and stay safe.